stop for a moment. Because what just happened in the metals market was not chaos. It was communication. Prices collapsed, then snapped back. Headlines screamed panic. Yet behind the screens, something very different was unfolding. If this was just volatility, why didn't physical demand flinch? If this was a breakdown, why are premiums refusing to fall? Two markets, telling two completely different stories, and only one of them reflects reality. What looks like disorder may actually be a transfer of control, from those forced to react to those prepared to wait. And the most important question is not where prices go next, but who is quietly positioning while everyone else is distracted. Stay with us, because by the end of this analysis, the turbulence will make sense, and the risk will look very different than it does right now. Welcome to Boring Currency Reports. If you value calm thinking over noise, take a quiet second and subscribe, like one does with a trusted newspaper they've read for years. And before we continue, tell us in the comments, from which country are you watching today? The story begins with a shock that appeared sudden, violent, and confusing. In a short span of time, silver prices fell sharply, rebounded just as aggressively, and left observers questioning what they had just witnessed. Gold, while more stable, remained near historically extreme levels, reinforcing the sense that something unusual was unfolding. To many, this looked like chaos. To others, it looked like failure. But to those who study economic stress carefully, such turbulence is rarely random. They understand that extreme price movement is often not the story itself. It is a signal. In periods of real stability, prices move slowly. They reflect balance, negotiation, and confidence. Violent moves tend to appear when confidence is thin and pressure is building beneath the surface. The recent turbulence in silver and gold followed this pattern closely. It arrived at a moment when global debt remained elevated, interest rate expectations were uncertain, and trust in forecasts was fragile. Many explanations rushed into the spotlight. Some blamed speculation, others blamed algorithms, technical levels, or emotional investors. These explanations described how prices moved, but not why the market was vulnerable enough for such a move to occur. The deeper issue was structure, not sentiment. Gold and silver occupy a unique role in the global system. They are traded like financial assets, yet held like insurance. They respond not only to growth and inflation, but to trust, fear, and confidence. When they move violently, it often reflects tension between two groups. One reacts to price, the other reacts to risk. This distinction is critical. In modern markets, much of the exposure to gold and silver exists in paper form. Futures, options, and derivatives dominate daily volume. These instruments allow speed and leverage, but they also introduce fragility. When prices move against leveraged positions, participants are not free to wait. They must respond to margin requirements and risk limits. Selling becomes mechanical. To the outside observer, this looks like panic. In reality, it is obligation. At the same time, another group exists beyond the screens. They move more slowly, they do not trade frequently, and they are not guided by intraday charts. They focus on preservation, supply security, and long-term confidence. For them, volatility is not a verdict, it is information. This contrast explains why the shock event matters. It reveals who is reacting and who is observing. During the sharp decline, quoted prices fell quickly. Yet reports from physical markets did not show the same collapse in behavior. Availability did not suddenly improve. Premiums did not disappear. This divergence suggested that selling pressure was concentrated in financial exposure, not in physical ownership. That gap is essential to understand. It indicates that the market was not rejecting gold and silver as assets. It was repricing risk within a leveraged system. The turbulence was not a judgment on the metals themselves. It was a stress test of the structure surrounding them. Experienced observers do not celebrate such moments, but they do not fear them either. They know that markets under pressure often exaggerate moves to remove weak positioning. This does not guarantee immediate recovery, and prices can always move lower, but volatility alone does not equal failure. Timing also matters. The shock occurred after a period of relative comfort. Trends had appeared steady. Narratives had become familiar. In markets, comfort often precedes disruption. When too many participants believe the same story, the system becomes fragile. From this perspective, the shock was not surprising. It was revealing. For business leaders and aspiring entrepreneurs, the lesson is not about predicting prices. It is about reading signals. Violent volatility often appears when risk is being redistributed. Those who react emotionally surrender control. Those who remain analytical gain insight. This event was not an ending. It was the opening of a larger story. It exposed a divide between what prices displayed and what behavior suggested. It hinted that two markets were operating at once, each governed by different incentives. And it raised a more important question than where prices will go next. The real question is who is being forced to move and who is choosing not to. To understand why silver and gold prices can move with such violence, one must step away from the idea that markets are guided primarily by human judgment. In the modern financial system, price is often shaped by machines, rules, and constraints long before emotion enters the picture. This is especially true in the paper metals market. They operate inside a system built for speed, leverage, and efficiency, not stability. Most gold and silver traded each day does not involve physical metal changing hands. It involves contracts, agreements to buy or sell metal at a future date, often without any intention of delivery. These contracts are layered with leverage, meaning a participant can control a large amount of exposure with relatively little capital. This structure allows markets to move quickly, but it also makes them fragile. When prices move in the wrong direction, leverage becomes a liability. A small decline can trigger margin calls. Margin calls force participants to add cash or reduce positions. If they cannot do so fast enough, their positions are liquidated automatically. This process does not care about fundamentals, long-term value, or supply constraints. It only cares about rules. As these forced actions stack on top of one another, selling accelerates. Stop-loss orders activate. Risk models adjust. Options dealers hedge. Funds reduce exposure because their mandates require it. None of this happens because someone has decided that silver or gold is suddenly worthless. It happens because the system demands compliance. This is how volatility is manufactured. To an outside observer, it looks like panic, but panic suggests choice. What is often happening instead is obligation. Participants are not choosing to sell, they are being compelled to sell. This dynamic explains why price moves can feel detached from reality. It also explains why these moves often occur during thin trading hours or around key technical levels. When liquidity is low, forced selling has an exaggerated effect. Prices fall faster than they would in a balanced market, creating the illusion of collapse. But the collapse is not in the metal, it is in the positioning. Another important feature of the paper market is its reliance on models. Many large institutions do not make decisions based on narrative or conviction. They follow algorithms that respond to volatility, correlations, and momentum. When volatility spikes, these models often reduce exposure across multiple assets at once. Gold and silver are not exempt from this behavior. As a result, metals can be sold not because of anything happening within their own markets, but because stress appears elsewhere. A shock in equities, credit, or currencies can lead to selling in metals simply because they are liquid and easy to trade. Liquidity, in this sense, becomes a weakness. Assets that can be sold quickly are often sold first. This creates a paradox where gold and silver, often viewed as safe havens, experience sharp declines during moments of stress. The decline is not a rejection of safety, it is a scramble for cash. This is why paper volatility must be interpreted carefully. It reflects the behavior of a system under pressure, not necessarily a change in long-term demand. There's also the issue of scale. The volume of paper claims on gold and silver far exceeds the amount of physical metal available for delivery. This leverage magnifies price moves. It allows large positions to be built and unwound rapidly, amplifying both gains and losses. In such an environment, stability is the exception, not the rule. For those unfamiliar with this structure, the speed of the moves can be shocking. For those who understand it, the shock lies elsewhere. It lies in how many participants continue to treat paper price as the final authority on value. Experienced observers know that paper markets are excellent at signaling stress. They are less reliable at signaling scarcity or long-term worth. This does not mean paper prices are meaningless. They matter. They influence sentiment, capital flows, and perception. But they are not the whole picture. They represent one arena of a larger system, governed by its own incentives and constraints. The danger arises when observers confuse paper volatility with real-world rejection, when they assume that falling prices mean falling interest, or that rising prices mean genuine tightness. In reality, paper markets often exaggerate both directions. This is why violent moves are common near turning points. They serve a function. They clear positions that cannot survive uncertainty. They punish overconfidence. They reward preparation. For business leaders and entrepreneurs, the lesson is not about trading metals. It is about understanding systems. In leveraged environments, price is often the output of stress, not clarity. Decisions made in response to that output, without understanding its source, tend to be reactive. The paper market machine does not care about patience. It rewards speed and penalizes hesitation. But outside that machine, another market exists, one that moves more slowly, reacts differently, and answers to different pressures. Understanding the difference between these two arenas is essential, because what appears as disorder in one may be discipline in the other. And that distinction leads directly to the next question. What is happening beyond the screens, where contracts end and real metal begins? While price screens flash red and green in rapid succession, another market moves quietly beneath the surface. It does not respond in milliseconds, it does not unwind with a keystroke, and it does not obey the same rules as leveraged finance. This is the physical gold and silver market, and during periods of turbulence it often tells a very different story. They who focus only on price rarely see it. The physical market is not a single place, it is a chain. It begins with mining and refining, moves through fabrication, and ends with delivery to investors, institutions, and industries. Each step introduces friction. That friction slows response, limits flexibility, and reveals stress earlier than paper markets do. Unlike contracts, physical metal cannot be created instantly. It must be mined, processed, transported, and secured. When demand rises, suddenly, the system cannot simply accelerate. Capacity is fixed in the short term. This is why physical markets do not mirror paper volatility. They absorb shocks differently. One of the clearest signals of this difference is premiums. Premiums represent the cost above the quoted price required to obtain real metal. They reflect fabrication capacity, logistics, availability, and urgency. When prices fall sharply but premiums remain firm, it suggests that the selling pressure exists primarily in financial exposure, not in physical ownership. This is not theory, it is behavior. During recent turbulence, reports from multiple regions pointed to steady or rising interest in physical gold and silver. Availability did not improve as prices fell. In some cases, it tightened. This is not what would be expected if demand were truly collapsing. It suggests that buyers were not reacting to price alone. They were responding to something deeper, that something is trust. In many parts of the world, gold and silver are not viewed as trades. They are viewed as savings. They are held to protect purchasing power, not to capture short-term gains. For these participants, volatility is not a reason to sell. It is often a reason to observe more closely, or even to act. The physical market also operates in tiers, and understanding these tiers is essential. At the top is wholesale metal, large bars used by refiners, manufacturers, and large institutions. Below that is fabricated investment metal, coins, rounds, and small bars. At the bottom is retail convenience, the exact products people want, in the exact form they trust. Stress appears first at the bottom. Retail-sized products are constrained by minting capacity, packaging, and distribution. When demand rises quickly, these products can disappear, even if large bars still exist somewhere in the system. This creates a misleading impression. Observers may see metal available at the wholesale level and assume there is no problem. Meanwhile, end buyers experience delays, higher costs, or empty shelves. This mismatch matters because perception drives behavior. And when individuals see physical metal becoming harder to obtain, their urgency increases. That urgency shows up in premiums, not always in price. Price, after all, is being set elsewhere, often by paper dynamics that have little to do with physical delivery. Another important aspect of the physical market is geography. Demand does not rise evenly across the world. It appears in clusters, influenced by local currencies, policies, and cultural attitudes toward savings. When similar patterns appear in regions with different systems and incentives, the signal becomes stronger. It suggests a shared concern. This does not mean every report should be taken at face value. Local shortages can be caused by temporary issues. Shipping delays, refinery maintenance, or regulatory changes can all affect availability. Serious analysis requires skepticism. But when multiple regions report similar friction at the same time, it becomes difficult to dismiss as coincidence. What makes the physical market especially important during turbulence is its resistance to forced behavior. There are no margin calls on a coin held in a vault. There is no algorithm demanding immediate liquidation. Owners of physical metal decide when and if they sell. That freedom changes the character of demand. It also changes the meaning of volatility. In the paper market, volatility often signals distress. In the physical market, it can signal opportunity or confirmation. This does not guarantee higher prices. It does not eliminate risk. But it does indicate that interest in the underlying asset has not disappeared simply because screens are unstable. For business leaders and entrepreneurs, this distinction offers a broader lesson. Not all markets respond to pressure the same way. Systems built for speed break differently than systems built for endurance. The physical market is slower, less flexible, and less dramatic, but it is also more revealing in times of stress. It shows where confidence is being quietly reallocated. Understanding this undercurrent does not require prediction. It requires observation. It requires watching behavior rather than headlines and structure rather than sentiment. And once that undercurrent is recognized, another question emerges. If physical demand is steady or strengthening and paper volatility is intensifying, who is positioned to benefit from this divide? That question leads directly to the strategic players operating between these two worlds. Markets are often described as crowds, but real influence rarely belongs to the crowd. During periods of turbulence, power concentrates quietly in the hands of those who are not forced to move. These are the strategic players, and their behavior is rarely visible in daily price action. They do not announce themselves, they do not explain their reasoning, and they do not respond to noise. In gold and silver markets, these players operate on a different timeline. They are not concerned with hourly charts or short-term volatility. Their decisions are shaped by balance sheets, supply security, and long-term confidence in the financial system. When prices move violently, they do not interpret it as a verdict. They interpret it as information. This is where misunderstanding begins. Most public narratives focus on retail investors and speculative traders. Their reactions are easy to observe. They post, they comment, they chase, and they panic. But these participants rarely determine outcomes. Outcomes are shaped by entities with the capacity to accumulate or hedge at scale and the patience to endure discomfort. During recent turbulence, attention has centered on price damage. What received less attention was positioning. Large positions were being built and maintained, while smaller participants were being forced to reduce exposure. This asymmetry is not accidental. It is a feature of leveraged markets. Strategic players understand that volatility can be used as a filter. When prices move sharply, they test conviction and capital. Those who cannot tolerate uncertainty are removed. Those who can remain gain relative influence. Over time, this process reshapes the ownership structure of the market. Another important element is the difference between exposure and control. In paper markets, a large position does not guarantee control. Contracts can be closed, rolled, or forced out. In physical markets, control is more direct. Metal held outright does not expire. It does not require renewal. It does not depend on counterparty performance. This is why large-scale physical accumulation carries a different strategic weight than financial exposure. At the same time, paper positions are not irrelevant. Large short positions, for example, can exert significant pressure on price, especially in thin or stressed conditions. When a substantial short exists alongside significant physical accumulation, tension builds. This tension does not resolve quickly. It creates instability that can persist for months or years. This is not a battle in the dramatic sense. It is a test of endurance. Strategic players are not trying to win headlines. They are trying to manage risk over time. A short position may be part of a broader portfolio strategy, not a directional bet. Physical accumulation may be driven by inventory needs, not speculation. Understanding this nuance is critical. Retail narratives often reduce complex positioning into simple stories of good and bad actors. This framing is misleading. Markets do not operate on morality, they operate on incentives. Strategic players respond to incentives with scale, patience, and optionality. Another overlooked aspect is discretion. Large participants avoid visibility because visibility creates response. When intentions become obvious, markets adjust, prices move, opportunities shrink. This is why serious accumulation rarely occurs during euphoric rallies. It occurs during confusion, when narratives are fragmented and attention is divided. Volatility creates that environment. It also creates fear, and fear discourages scrutiny. When observers are focused on losses or gains, they pay less attention to structural shifts. This allows strategic positioning to proceed with less resistance. For business leaders and entrepreneurs, this dynamic offers a valuable parallel. In competitive environments, advantage is rarely gained by reacting to surface-level signals. It is gained by understanding who is constrained and who is flexible. In markets, as in business, those with optionality survive disruption better than those without it. The metals market during turbulence becomes a case study in constraint. Smaller participants are constrained by leverage, timing, and emotion. Larger participants are constrained only by policy, liquidity, and long-term strategy. The difference between these constraints determines who adapts and who is forced to exit. This does not mean that strategic players are always correct. They can misjudge timing, policy, or macro conditions, but they are less likely to be removed from the game by a single adverse move. Survival is their first advantage. This is why watching price alone is insufficient. Price shows what is happening at the margin. It does not show who is gaining control. Control is revealed through persistence, through accumulation during weakness, through the ability to hold positions despite volatility. These signals are subtle, but they matter. As turbulence continues, the focus shifts from who sold to who did not, from who reacted to who absorbed, and from price damage to balance sheet resilience. Understanding where power concentrates during these periods changes how the entire market is interpreted. It reframes volatility as a process, not an outcome. And once this concentration of power is recognized, the next question naturally follows: how does this shift in positioning eventually surface in the broader financial system? That question leads directly to the role of capital rotation and the industries that transmit it. Market turbulence rarely remains contained. When stress builds in one corner of the financial system, it eventually spreads, not through panic, but through capital reallocation. This process is slow at first, almost invisible, but once it begins, it reshapes attention and valuation across entire sectors. In the case of gold and silver, this transmission effect often runs through one overlooked channel. They call it mining. For many investors, mining companies are an afterthought. They are seen as risky, cyclical, and difficult to analyze. Over the past decade, they have been ignored by large segments of institutional capital. This neglect has consequences. It leaves the sector small, underowned, and sensitive to change. When metals prices rise quietly, the metal itself reflects that shift. But when prices remain elevated long enough to affect cash flows, something more important happens. earnings begin to change, and earnings attract attention. This is where capital rotation starts. Mining companies sit between raw metal and financial markets. They convert price into revenue and revenue into cash flow. When margins expand, even skeptical investors are forced to look, not because they believe in a narrative, but because the numbers demand explanation. This matters because institutional capital does not move based on emotion. It moves based on mandates, benchmarks, and relative performance. When a small sector begins to outperform, it creates pressure. Portfolio managers must decide whether to ignore it and risk underperformance or allocate and participate. In this way, mining becomes a signal amplifier. The transmission effect works like this. Sustained metals prices improve mining margins. Improved margins lead to better earnings reports. Better earnings draw analyst revisions. Revisions attract capital. Capital inflows reprice the sector. That repricing feeds back into broader awareness of the underlying metals. This process does not require excitement. It requires consistency. Another reason mining matters is scale. The mining sector represents a small fraction of global equity markets. This means it does not take much capital to move it. Even modest reallocations can produce outsized effects. This asymmetry makes the sector volatile, but it also makes it responsive. From a strategic perspective, this responsiveness is important. When capital rotates into mining, it changes the narrative around metals. Gold and silver stop being viewed solely as defensive holdings or speculative trades. They become productive assets again. They generate cash. They pay dividends. They compete for capital alongside technology, energy, and industrial firms. This shift has broader implications. Governments and institutions have begun to pay closer attention to supply chains and strategic resources. Secure access to materials has become a policy concern, not just a market one. Mining companies sit at the center of this conversation. They are no longer just extractors. They are suppliers to national priorities. This policy undertone reinforces the transmission effect. When earnings align with strategic relevance, capital becomes more patient. Long-term investors become more willing to engage. This changes how volatility is interpreted. Short-term price swings matter less when long-term access matters more. It is important, however, to maintain perspective. Mining companies are not substitutes for metals. They carry operational risk, political risk, and management risk. A strong metal price does not guarantee a strong company. History offers many examples of poor capital discipline, destroying shareholder value even in favorable environments. This is why capital rotation is selective. Not all miners benefit equally. Capital flows toward balance sheets that can survive volatility, management teams that prioritize returns, and projects that are politically and economically viable. This selection process further concentrates influence within the sector. For entrepreneurs and business leaders, this dynamic offers another lesson. Markets reward clarity of execution when attention returns. Sectors that have been ignored are judged harshly when they re-enter the spotlight. Only those that have prepared survive scrutiny. The transmission effect also explains why metals turbulence matters beyond the metals market. It affects equity valuations, sector leadership, and portfolio construction. It shifts conversations in boardrooms and investment committees, and it does so quietly before headlines catch up. By the time mining becomes widely discussed, the rotation is already underway. The early stages occur while volatility dominates attention elsewhere. This is why understanding transmission is more valuable than predicting price. It reveals how stress becomes structure. As capital reallocates, it confirms that turbulence was not random. It was part of a process through which markets reassess value, risk, and relevance. Gold and silver volatility becomes the trigger, not the destination. With this transmission in motion, one final question remains. What does all of this mean for those responsible for making long-term decisions? That question brings the story to its conclusion. As the turbulence settles into memory, the final task is not interpretation of price, but interpretation of meaning. Markets rarely deliver clear messages in calm language. They communicate through stress, contradiction, and discomfort. Gold and silver have done exactly that. The question for decision makers is not whether volatility will continue. It is whether they understand what the volatility is saying. They who focus only on direction often miss the signal. The events described across this analysis point to a system under pressure, not a market in decline. Violent price movement, diverging behavior between paper and physical markets, quiet accumulation, and early capital rotation are not random occurrences. Together, they form a pattern that serious observers recognize. It is the pattern of repricing risk in an environment where confidence is uneven. One of the most important strategic implications is the separation between liquidity and value. In moments of stress, liquidity dominates behavior. Assets that can be sold quickly are sold quickly. This does not mean those assets have lost relevance. It means they have become tools for adjustment. Gold and silver, because they are liquid and widely held, often absorb this pressure first. This reality challenges simplistic narratives. A falling price does not automatically mean falling demand. A rising price does not automatically mean scarcity. Price is influenced by structure, incentives, and constraints. Understanding those forces is more important than reacting to the outcome. Another implication concerns time horizon. Short-term volatility punishes those who rely on immediate feedback. Long-term positioning rewards those who can tolerate uncertainty. The divergence between paper volatility and physical stability highlights this difference clearly. One market responds instantly, the other responds deliberately. Decision makers must decide which framework aligns with their objectives. For business leaders, this distinction mirrors strategic planning. Companies that chase quarterly signals often sacrifice resilience. Those that invest in fundamentals endure cycles. Markets operate in a similar way. Volatility exposes weak alignment between strategy and structure. There's also a lesson in observation. The most valuable signals during turbulence are not headlines or forecasts, they are behaviors. Who is forced to sell, who is able to hold, where friction appears, where it does not. These details reveal far more than predictions. Another critical implication lies in humility. No analysis guarantees outcome. Physical tightness does not guarantee rising prices. Capital rotation does not guarantee sustained performance. Strategic players can misjudge conditions. Policy can change. Liquidity can tighten further. Uncertainty remains. What changes, however, is preparedness. Prepared participants do not require certainty. They require clarity about risk. They avoid leverage that forces decisions. They avoid narratives that demand immediacy. They structure positions and strategies to survive volatility, not avoid it. This mindset is especially important for young entrepreneurs and aspiring business leaders. Markets, like businesses, are not linear. They move in cycles of expansion, correction, and consolidation. Those who mistake turbulence for failure often exit just as conditions begin to change. Another implication involves attention. Markets are competitive environments for attention as much as capital. Volatility attracts noise. Noise distracts from structure. While focus remains on dramatic moves, deeper shifts occur quietly. Capital reallocates. Strategies adjust. Positions change hands. Those who learn to look past noise gain time. Time is advantage. The final implication concerns trust. Gold and silver are not just commodities. They are trust instruments. They reflect confidence in systems, currencies, and promises. When they behave erratically, it often reflects disagreement about the future, not clarity about the present. But this disagreement is healthy. It signals debate, not collapse. The greatest risk arises when debate disappears and consensus hardens. That is when systems become fragile. The recent turbulence suggests the opposite. It suggests uncertainty, repositioning, and reassessment. These are signs of a system adapting. For decision makers, the appropriate response is not urgency, it is discipline. They should watch indicators that matter: physical availability and premiums, balance sheets and cash flows, policy language and capital flows, liquidity conditions, and real rates. These signals evolve more slowly than price, but they are more durable. They should also resist false precision. Markets do not offer clean timelines, they offer probabilities. Strategy is not about being right quickly, it is about being wrong slowly enough to adjust. The story of silver and gold turbulence is not a warning of imminent collapse. It is a reminder of how stress reveals structure. It shows how systems behave when confidence is uneven. It highlights the difference between reaction and preparation. In the end, the metal does not change. An ounce remains an ounce. What changes is the story told about it, and who believes that story strongly enough to act. Those who can read the signal beneath the noise do not need certainty. They need perspective. And in environments like this, perspective is the most valuable asset of all.